Hello and welcome to Real Estate. This video is intended as the first one in a series that'll introduce the idea of real estate investing, explain why people invest in real estate, how it's done, and how an investor can evaluate and value a real estate investment opportunity. So let's get cooking with it. There are a number of different ways to invest in real estate. The one that generally comes to mind when real estate investing is brought up is equity investing. And this can be done by directly investing in real estate, buying a property directly, but can also be done by investing in REITs, real estate investment trusts. These are portfolios of real estate that are managed by the portfolio manager, and they trade on public markets. There are also private real estate funds as well. And then there are REOCs, real estate operating companies, which aren't direct exposure into the real estate itself, but are an investment into the stock of a company that operates properties. This could be something like an apartment management company. There's also debt investing in real estate, and the most common form this takes is mortgage lending, typically done by banks or private debt lenders. And it's not only mortgage lending, there's also financing lending, loans made to real estate companies or developers, and a type of mortgage investing that has been very heavily discussed since 2008, MBSs, mortgage-backed securities, which are fixed income securities that are backed up by a pool of mortgage loans. So the question that immediately comes up is, why invest in real estate? The stock market's right there, the bond market's right there, so what makes real estate worthwhile in its own? Well, very often there's an income stream that comes from real estate investing. Take, for example, an apartment building. Those rents that are collected monthly provide the investor an income stream. Similarly, the payments received for an office building or a storefront. This gives an almost fixed income-like quality to real estate investments. But there's also capital appreciation that comes from real estate investing. A building can rise in price as improvements are made to it. An area can improve that a building is in, causing it to rise in price. Or an increase in demand for a certain type of property can push its value up. This element of real estate gives it an almost stock-like quality. Then there are diversification elements. If an investor has a portfolio that's mostly stocks, then investing in real estate could give some uncorrelated returns. However, they're not completely uncorrelated, and there is some debate as to exactly how much diversification it does offer, but it is a separate asset class from equities and could give diversification benefits. And this will vary based on what type of real estate is being invested in. In an economic downturn, holding office properties versus holding apartment properties would be expected to have very different performance. And there's also an element of inflation hedging. As inflation increases, most often property values increase, but more than that, that income stream can adjust with inflation as well. As inflation rises, the property owner could raise rents to reflect inflation. And generally, the shorter the amount of time between rent contract renewals come up, the more responsive an investment will be to increases in inflation. Most often, real estate investments are levered, whether on an individual purchasing investment property or on the REIT level. Typically, properties are purchased with a mortgage. This ends up providing levered returns to the investor, but could also be risky since leverage also increases downside risk. So, say someone has decided to invest in real estate. But what sort of properties to invest in? There are a lot of different properties that are out there that all have their own characteristics. Residential real estate is the most common one, the most common of those being single-family properties. This is the investment someone makes when they decide to buy a single-family home for their family to live in. Another very common form of residential real estate investing are multifamily properties and apartments. And these tend to be very responsive to changes in overall population, changes in regional population, and are responsive to inflation, since typically the time between rent renewals is pretty short, typically on one-year contracts. Industrial real estate very often is occupied by one renter. Industrial real estate could be something like a factory, a place where industry happens. In a situation, however, where the property owner has one or two tenants who use it for their industrial purposes, there's much higher vacancy risk, as if one or both of those occupants leave, it could take a long time before a new occupant is found, leaving a large period open in which rents aren't being collected. Warehouses are typically used for industrial or commercial purposes, and they're just a large storage area to keep supplies or merchandise in. Offices can vary a great degree, and they typically derive income from occupants paying to use it to run their companies in. Now, offices can be very small and could be rented to just one person who's using the space, but to go all the way up to Class A properties, which are entire office towers that dominate city skylines. This type of investing has seen the concept of the trophy building, where some investors might want to have their name on the tallest building in the city, or be the owner, for a bit of personal grandiosity. Retail is similar, but they're used to sell products out of. Now, this could be something as simple as a storefront, a gas station, something like that, but could go all the way up to large shopping centers or malls. Malls typically have a certain risk that's not associated with other storefronts, and that they rely very often on anchor tenants, which is one very large, well-known store that takes up a large amount of space, and the hope is that that tenant stays there because there's some fear that if that one whale tenant were to leave, then traffic to the entire complex might dry up. For that reason, mall investors have very often signed longer-term contracts with anchor tenants, but ones that offer them more beneficial terms. Hotels are another one, and these ones are very often operated by a real estate operating company, or they are part of a franchise. And one thing to note that arises very often with hotels is that very often they are much more seasonal businesses. Storage and self-storage are another category, and one thing about self-storage that investors very often like is that they usually have very short rent contracts that come up for renewal, sometimes monthly, which gives the investor an opportunity to change rents in response to inflation, for example, at a very short time interval. Then there are specialty properties, and I can't go through all of them, but one that I do want to bring up, data centers. And data centers have grown in demand enormously in just the past couple years. So they're a type of property that is very much being watched right now. The last one I'm going to go through is land. Now, the land could be in use, for example, timberland and timber REITs, which have the interesting quality of both producing wood, but also have the ability to function almost like a warehouse, foregoing the cutting down of trees one year and storing them to grow into more wood the next. Land could also be purchased and not used in the hope that that land will become more in demand and thus more valuable later on. So I mentioned REITs, real estate investment trusts, and they are portfolios of multiple properties. Many REITs can be purchased on public markets, and for a REIT to remain as a REIT, it must pay out 90 or more % of its taxable income as dividends each year. In a REIT, the portfolio of properties is managed by the REIT, and dividends pay out income, and the value of the REIT shares can change in price to mirror capital appreciation. Now, there are very different types of REITs that are out there. Ones dedicated to different types of real estate, office REITs, residential REITs, timber REITs. But then there are also ones that have multiple types of property in it. REITs can be differentiated by region, say a Northeast apartment REIT or a Southwest apartment REIT. And this gives investors quite a lot to work with to find what they want for their portfolio. As with publicly traded shares of other companies, their financial information is made public. Mortgage-backed securities, and shout out to the Big Short on this one, mortgage-backed securities are a fixed income security that makes regular payments to its owners. A mortgage-backed security is built by first taking a bunch of mortgages, either issued by banks or private lenders, pulling them all together into one portfolio, and then that portfolio issues the mortgage-backed security and pays out to the people who buy it. There are mortgage REITs, or MREITs, that operate by buying or originating mortgage loans, or by purchasing mortgage-backed securities, and paying that income out to their investors. Mortgage REITs may employ leverage on their own end to enhance returns to their investors. So how do you find out what the value of a real estate investment is? Well, there isn't an answer, but there are a number of different techniques that have been developed in an attempt to value real estate. One technique is the comparable sales approach, and this is done by looking at sales that are comparable to the building that the investor is looking at. The investor will try to find properties that are roughly similar to the property they're looking at and ask, how much did those sell for? Then that property probably isn't the exact same building, so the investor will adjust some variables in an attempt to approximate what the value should be. That could be something like condition. If the comparable building was sold for a certain amount, and the building the investor is looking at is in slightly worse condition, then the investor might assume that that building should sell for, say, 10% less, depending on how different the conditions are between the two. Another variable worth adjustment could be age. An older building could be expected to sell for less. So if the building being compared to was a little bit younger, then the investor might assume that their building is worth a little bit less. Location can also change the value. A more high in-demand area could make a building worth more. And size differences. If the building the investor is looking at is 5% larger, for example, than the comparable building, then it could be worth 5% more than that building. And by finding more and more comparable sales, an investor can get a more accurate sense of how to compare buildings. Finding a building that's 5% larger and 5% smaller helps to find a more accurate spot for what that size difference should be worth. Finding buildings sold with different ages helps. So the more comparables an investor can use and finding what that sale price was really helps to improve the accuracy of building valuation. Next, we have income-based approaches, and there are different ways of going about these, but the general idea behind all of them is valuing a property based on the rents that will be collected from its investment. The direct capitalization method takes the net operating income of the property and divides it by a capitalization rate, or the cap rate. What the net operating income is the operating income less the operating expenses. So that ends up being the income to the property after operating expenses have been paid. So once we have net operating income, we need to divide that by a cap rate. And there are tables that show cap rates in general geographic areas for different property types, but what its overall construction is a discount rate minus a growth rate. So let's say we're looking at a building that has a net operating income of $1.5 million. The discount rate is 5%, and the expected growth rate is 2%. Well, we'll take that $1.5 million and divide it by 0.05 minus 0.02. That ends up being 1.5 million divided by 0.03. And when we solve that, we get 50 million. So using the direct capitalization method with these inputs, we would say the building is worth $50 million. We can also use discounted cash flows, like we've seen in earlier videos in the series. So to do this, we'll take operating cash flows in year 1, divide that by 1 plus the discount rate, and then add operating cash flows in year 2, divide that by 1 plus the discount rate squared, and go so on until we get to that final year that we're looking at, likely the investment horizon that the investor has in mind, and add a terminal value and discount that as well. And that terminal value is the value the investor expects the property to be worth at that time. How much the investor expects to be able to sell the property at the end of the investment time horizon. So let's try a 3-year investment horizon with a 5% discount rate and cash flows of $50,000 the first year, $50,000 the second year, $60,000 the third year, and a terminal value of $1.4 million. Well, we'll discount the $50,000 operating cash flow in year 1 by 1.05, the $50,000 operating cash flow in year 2 by 1.05 squared, the $60,000 operating cash flow by 1.05 cubed, and then we add 1.4 million divided by 1.05 cubed for the terminal value. And when we solve this, we end up with the value of $1,354,173.42. Another common method is the cost approach. And this attempts to arrive at the value for a property by asking the question, how much would it cost to build this property entirely from scratch? And this requires factoring in many components, like the cost of materials, the cost of construction labor, land, architecture and architectural engineering, the cost of any improvements that need to be made, the labor costs to supervise the construction, any legal costs that might be incurred, the cost of insurance, any brokerage fees, and any environmental or other assessments. And when looking at a REIT, there's a lot of similarity to valuing an individual property since ultimately a REIT is a portfolio of properties, but there are a few other elements that need to be taken into consideration. When using an income-based approach to value a REIT, there are proxies that can be used for income, two main ones being funds from operations, FFO, and adjusted funds from operations, AFFO. Funds from operations can be derived from taking the net income, adding any depreciation charges, subtracting any gains from property sales, and adding losses from property sales. Adjusted funds from operations can be taken by using funds from operations and adjusting that value for any recurring capital expenditures. REITs can also be valued with an asset-based approach, and this is done by adding the values of all of the individual properties in the portfolio together to arrive at a portfolio value. Now, investors may make many adjustments to that sum of the parts valuation, but one that's very key is the management team of the REIT. A good management team could be expected to grow property values, to shrink vacancies, to grow rents, or to get more efficiency than a bad management team. So the quality of a REIT's management team is most likely going to end up reflected in the share price. Well, I hope this has been useful, and if you enjoy the finance series, then please do subscribe. I will certainly be doing more alternative assets. And until then, have a night.